Retirement accounts offer excellent tax perks, like deferring or even eliminating income taxes. However, the downside is that following IRS or Internal Revenue Service regulations can be challenging. Knowing the rules can help you avoid costly mistakes and save a lot more for retirement. A great example that we'll cover today is an often underutilized retirement strategy called a spousal IRA. So this podcast will explain what a spousal IRA is, its benefits, and who can use one to invest more for retirement. Welcome back, everyone. Thanks for joining me. I'm Laura Adams, a money speaker, spokesperson, and award-winning author of several books. You might be interested in grabbing a copy of Debt-Free Blueprint, How to Get Out of Debt and Build a Financial Life You Love, or my most recent title, Money Smart Solopreneur, a personal finance system for freelancers, entrepreneurs, and side hustlers. Money Smart Solopreneur was a #1 Amazon new release. Both books are available as paperbacks, ebooks, and audiobooks. Before we start, I want to thank a reviewer on Apple Podcast, Teyase, who says, "Love this podcast. Great information with thorough research and data. Keep up the good work." Thank you so much for the review. I really appreciate it. If you're also getting value from the show or maybe have used it to level up your finances, I would love to get your rating or review in the podcast app of your choice. Or maybe you have a question I can answer on the show. Call 302-364-0308 and leave a voice message. You can also send an email using my contact page at lauradadams.com. And while you're there, sign up for The Money Stack. It's my free newsletter that goes out 3 or 4 times a month with great money tips, advice, recommendations, news, all kinds of things going on in my world and in the financial world, plus invitations to live educational events. So I would love to see you join the list. So before we can really understand the benefits of a spousal IRA, it helps to review who qualifies for an IRA in the first place. So let's talk about that. IRAs are typically available to anyone with earned income, regardless of age. So even seniors and minors can have an IRA. But I'll explain how a spousal IRA is a terrific exception to the income part of that. So with a traditional IRA, your contributions are pre-tax. That reduces your taxable income in the same year. You only pay income tax on contributions or investment earnings once you take withdrawals in retirement. And the IRS does require you to take taxable distributions starting at age 72 or 73. They're known as required minimum distributions or RMDs. With a Roth IRA, contributions are after tax, so you don't get a tax break in the current year, but you pay no additional income tax on them or your investment earnings when you make withdrawals in retirement. So you get tax-free income in retirement, and there are no required minimum distributions from Roth accounts. To contribute to either type of IRA, you generally must have taxable compensation, like a salary, wages, commissions, tips, bonuses, or net income from self-employment. Other types of income you may have, like alimony, investment earnings, and payments from a pension or annuity, don't count as compensation when qualifying for IRA contributions. So remember that. It's got to be from earned income. However, there is an annual income threshold you can't exceed to qualify for a Roth IRA. The Roth IRA is the only retirement account where your income comes into play. For 2024, single taxpayers with modified adjusted gross income, which is shortened to MAGI or MAGI, if you have MAGI below $161,000, you qualify to contribute. And if you're married and filed joint taxes, your household MAGI can't exceed $240,000 to make IRA contributions. Another important rule is that when your spouse participates in a workplace retirement plan, like a 401k or 403b, your ability to deduct traditional IRA contributions may be reduced or even eliminated based on their income. But there's no conflict with maxing out a workplace retirement plan and a Roth IRA in the same year. That's because your Roth contributions are made on an after-tax basis. So let's talk about how much you can contribute to an IRA. For 2024, you can contribute an amount to a traditional or Roth IRA equal to your qualified compensation up to a maximum of $7,000 or $8,000 if you're over 50. For example, let's say you're a student who earns $2,000 working a summer job. You could contribute $2,000 to a traditional or Roth IRA. But if you're 40 and you earn $100,000, you can contribute at most $7,000 to either type of IRA, or maybe a combination of both. It could be $3,500 to one, $3,500 to the other, or $1,000 to one, $6,000 to the other. It could be in any combination that you like. Withdrawals of untaxed funds from retirement accounts before age 59 and a half are typically subject to income tax plus an additional 10% early withdrawal penalty. Therefore, you generally shouldn't put money in a retirement account that you might need to spend. It's best to avoid tapping a retirement account early so you can leave it alone and let it reach its full growth potential. So what would happen if you lost your job or you quit working to be a stay-at-home parent or caretaker? As I mentioned, you typically can only contribute to an IRA with your own qualifying earned income. Well, here's the exception. If you're married and file a joint tax return, you can take advantage of a spousal IRA if one of you has qualifying income. So a spousal IRA isn't a different type of IRA. It's a rule that allows a married breadwinner to fund their spouse's IRA, even if that spouse has little or no income. So it's a workaround that enables a working spouse to contribute to an IRA owned by their non-working spouse. But note that the rule does not apply if you're married and file taxes separately, or if you're living together and not married. Also note that an IRA can never be owned jointly, even if you are married. They're always individual accounts. Let me give you an example of how a spousal IRA might work. Let's say Dave and Terry are newlyweds and they're in their 30s and they decide to start a family. And one of them wants to take extended time off from work to be a caretaker, and they file a joint tax return. In that case, each can fully fund a traditional or Roth IRA. As I mentioned, for 2024, a non-working spouse under 50 can have IRA contributions up to $7,000. Therefore, Dave and Terry's total combined IRA contributions could be $14,000. However, if one spouse were over 50, the couple could save $15,000. That would be $7,000 in one account and $8,000 in the other. Or if a couple is over 50, they could contribute up to $16,000, $8,000 in each of their accounts, even if one of them has no income. Remember that it wouldn't be possible to fund an IRA while you're unemployed without using the spousal IRA strategy. Note that when you are eligible for an IRA contribution on your own or due to a spouse's income, the funds can come from any source, like household income or even a cash gift. For example, if you have a teenage child who works part-time and earns $2,000 but spends all of it, you or someone else, like a grandparent, could contribute $2,000 to the teen's IRA on their behalf, as long as they qualify for that contribution. So never miss the opportunity to fund an IRA for a child or for yourself if you're married and not working. Once you have a spousal IRA, you own the account, no matter who made its contributions. So no matter why you may be out of the workforce, don't let essential goals like retirement take a back seat. It's just as important to prioritize your financial future as it is for someone with their own earned income. Regularly investing in a tax-advantaged retirement account for long-term growth gives you the best opportunity to reach your retirement goals. For IRAs, you have until your tax filing deadline to make contributions for the previous year. So if you want to max out an IRA for 2024, you have until April 15, 2025. If you already have an IRA, you can use that account for spousal IRA contributions if you're eligible. Or you can also open a new IRA with any financial institution or investing firm. Then you choose how to invest the contributions based on your risk tolerance and goals. While you might consider your spouse's retirement account kind of like a joint asset, they are always individual accounts. Therefore, building wealth for your future as an individual with a retirement account in your own name is critical. I hope this has been helpful. If you have questions about IRAs or other types of retirement accounts or something totally different going on in your financial life, I'd love to hear from you. Again, reach me at lauradadams.com. And while you're there, if you hit the button to subscribe to The Money Stack, you can also just hit reply when you get that email from me to send me a note or an email message. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank everyone on our amazing team. The show is audio engineered by Steve Rickyberg. Our director of podcast is Brandon Gachus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. And our marketing and publicity associate is Davina Tomlin.